Good afternoon, everybody. My name is Mike Sears. I'm the president and founder of Sears Wealth Management and Insurance Solutions, and we're delighted to be with each of you on this 30-minute Thursday. I'd also like to welcome my co-host, Seth Morris, who's also a financial advisor in our firm. Seth, welcome. Glad to have you with us today.
Glad to be here, Mike.
Well, thank you for attending with us for this short period of time. Hopefully tonight will be, this afternoon will be an informative session, as today we're going to talk about long-term care. And so Seth, what are your thoughts about long-term care?
So long-term care is kind of a touchy subject. I know when we talk about it with our clients, they don't like to even bring it up, and no one wants to think of themselves needing it one day.
Well, I believe that's true. I in fact, in my own case, Seth, my own mother was in an assisted living facility for about just shy of 3 years. And that was a tough decision to bring her there. Mom had dementia. However, they took amazing care of her, and we were very grateful that, that we had the care that we needed when we needed it.
Yeah, I think most of us can think of someone we know who's needed long-term care, or someone who's helped someone who's needed long-term care. And what exactly is long-term care, Mike? What does that entail?
Long-term care really is designed to take care of the basic needs that we have. We call them the activities of daily living. Things like I can't eat without assistance. I can't bathe without assistance. I can't transfer myself from one room to another or out of bed to a chair without assistance. I'm incontinent. Also could be that I have dementia. All of those things as a result of having health challenges. I need help with those things. I can't do it myself. And long-term care really was designed to help take care of those types of needs.
Okay, so if I can't, do those things that you just mentioned, those activities, what types of care is available to me?
I think, most of you who are watching this today would say in a moment that the kind of care that you're really looking for is home care, right? We could have, with the help of some assistance, and a lot of times it's mostly family members that are helping us, but it could be someone else, a formal caregiver that's helping you. It could be a nurse that's helping you. But basically, where you're getting care at home, it could be someone actually starting out, I need help cooking my meals. I need help, someone helping to pay the bills. I can't do it on my own. And then that usually, if the care is needed more, I need help with bathing and transferring myself, those types of things. It usually increases.
Okay. What are the chances that that I would need that type of care? I don't foresee myself needing that. And like I said, I don't like to think about it, but what are my chances?
Well, interestingly enough, the data shows that if you had someone who was 65 years of age, Seth, that there's a 70% chance that someone will probably need care sometime during their lifetime. And then, of course, if you get a little deeper in the data, what we learn is that women will probably, and rightfully so, because women live longer than men, there's a 53% chance that women will need care, some type of long-term care, and a 47% chance that men will also need some type of care during their lifetime.
So at first you said 70% chance. So 7 out of 10 of us are going to need long-term care at some point in our lives, statistically. No. What is the cost of that? What does this all cost?
Well, it depends on the level of care. I started out saying that most people want home health care, and that's what nobody on this that's watching today wants to go into a nursing home. Especially after what happened with COVID, no one wants to go there. And so the levels of care really depend on how much care you need, but usually it starts at home and it's part-time. There are some people who have round-the-clock home care. That's how they want it. I think that's how we would all of us want it. And then from there, it could be there's adult daycare services. Those are community-based services that are provided for people that they can go there during the day, They can get help. They can have meals. They can get assistance with their needs that way. And then there's assisted living. Assisted living is kind of a hybrid. You have your own apartment to live in, but you also have care through nurses and other care workers in that facility. And of course, that's where my mom was. And then, of course, that an assisted living facility could also have a dementia unit just for those that have Alzheimer's as well. And then, of course, the last level of care is round-the-clock care, 24-hour clock, round-the-clock care, which would be skilled nursing care, or what we're most familiar with is full-blown nursing care, which really no one wants to go to.
Yeah, no, I remember my first job, Mike. I worked in a nursing home, a skilled nursing facility when I was 15 and a half. And I remember the level of care that these people, was provided to them. And I often thought, how are these people paying for this? And so how do people pay for this long-term care that they need, Mike?
I was astounded, actually, to find. I would have thought that most people would have had some type of insurance or were paying for it out of their own pocket. But interestingly enough, 57%, at least that's what the numbers show, are having their long-term care paid for by the government through Medicaid. That's typically what we find. However, to receive that kind of benefit, you've got to really spend down your assets quite substantially, almost to a very small amount of assets to qualify for that. 11% of the benefits are coming through Social Security, but there's just a small number of days. I believe the maximum number of days after a hospital stay would be 100 days of Social Security paying a benefit. Only 12% of families are paying for long-term care out of their own pocket, and only 5% of all families have long-term care insurance to pay for this very, very costly benefit, which, by the way, Seth, the cost on long-term care, as I said, home care is about $60,000. Assisted living can be more. My mother's care was $7,500 a month. If you're in a nursing home, that could be anywhere from $110,000 to $140,000 a year. Very, very costly.
Wow. So you said only 5% of these people have long-term care insurance policies, and obviously that's what we're talking about here today. So if only 5% of people have them, why would I want one? Why do I need a long-term care policy?
Well, I guess the question is, why do you buy insurance at all? I mean, we all buy insurance because we don't, for example, we buy car insurance because there's a likelihood if we're in a car wreck, we don't want to pay for it out of our own pocket. And there really are, Seth, two different types of long-term. I mean, what are our options, really? One option is we just simply self-insure, right? That's one option that we have. We have rainy day money set aside, and we're going to use those funds to, if we have a catastrophic healthcare event, we're going to pay for it out of our own pocket. That may be one option. Another option would be as a traditional long-term care policy. And a traditional long-term care policy is really it's like any other insurance type product. You pay a premium, and you pay a premium every single year. And if you need the coverage, you have it. The trigger, by the way, the benefit trigger for long-term care is the inability to do 2 out of 6 activities of daily living. So if you're unable to do, 2 out of those 6, I can't bathe without assistance. I can't eat without assistance. I can't transfer myself from one room to another without assistance. Those types of things. Or if I have Alzheimer's or dementia, which would pretty much automatically qualify you for the benefit. But if you can't do 2 out of 6 activities of those daily living, and your physician certifies to that fact, you then qualify for the benefit. And that benefit is usually paid over a certain amount per day, $100 a day, $200 per day, $500 per day, depending upon what you purchased, and for whatever period of time you purchased in the policy.
So we have the traditional policies, you qualify, you go on care, you pay a premium as long as you need to before you go on care. What is a linked benefit policy? I've heard of, we talk about that a lot. What is that? A linked benefit, actually, and for those of you on the call not familiar with that, this may seem very new to you, but a linked benefit really is
It is a long-term care policy. I call it a hybrid policy because it is linked to a permanent life insurance contract, is really what it is.
Okay. So we have traditional policies, linked policies. How do I know how much long-term care insurance I should have? How do I determine that amount?
Okay, why don't I do that? I'm going to try to draw something on the board here. Let's see if you can see it here. Hope you can all see this T. When we're talking about long-term care insurance, there's another part of this that we haven't said yet, Seth, and that is that a long-term care policy is really an asset protection tool because of the costly expenses that we could incur having to pay for long-term care. What we're trying to do is also preserve our assets. But usually, so let's just say as an example that I have coming in my household as far as income is concerned. Let's suppose that I have $5,000 a month that I have as far as income is concerned. And we know that if somebody needs care, we have to look at two things. We have to look at the person who is sick. Could be mom or dad, right? One of the spouses is sick. And then I have another spouse who's well. And so what I want to know is, the first thing that I want to know, Seth, is how much money per month does the well spouse, the spouse that is at home, need? Now, I know this well because this is what happened in our family. Mom ended up in a nursing facility, assisted nursing facility, and we needed to find out what my stepfather needed per month. And Seth, he needed about $4,000 per month to stay in his home and to live. Well, they only had about 5,000 coming in the door, right? That's all they had. So that only left the sick spouse with $1,000. But the cost was almost $7,000. So we needed to come up with somehow another $6,000 per month to take care of mom. And so can you see what's happening here? Is that if I have, so what I'm trying to get to is that it's rare that you can use just long-term care insurance to pay the whole bill.
Mm-hmm.
There usually isn't enough. You can't almost buy enough to do that. But I can fill in the gaps here with what I need. So I've got to come up with another $6,000 a month from somewhere. And I have some choices. One choice is I could just use up my assets. I could spend down my assets, but then my income is going to go down if I do that, right? So this is where long-term care bridges a wonderful gap. So I need somehow or another to solve for an additional $6,000 per month. And I could do that. And I could do that with a traditional type policy, right? I qualify and say, okay, how much does it cost for me to provide $6,000 a month in long-term care benefits? And I pay for that. That would be one way. And as I said before, a traditional policy is you pay the premium until you need the benefits, right? If you never needed the benefit, well, at least you had the policy and you paid the cost and you have it. Now, a linked benefit is an interesting, this hybrid benefit is very different than the traditional policy. So let me go ahead and I'm going to erase this for a second. I wish I had more space because I really want to keep that piece up because it's really important to understand that when we're talking about long-term care insurance, we're not talking about buying all of the need. We're just trying to fill in the gap between the amount of income that I have coming in and what I'm short, because I got to take care of, remember what I said? We got to take care of the well spouse and who else, Seth?
And the sick spouse.
Yeah.
The spouse that needs care.
Yeah, I need both of them, right? I need to do that. So how does this hybrid policy works? So what happens is we're going to create 3 boxes. And really, this is 3 boxes of benefits is really what this is. And so this hybrid policy is for the person, it only works for the person who says, I already have rainy day money set aside. And I'm going to use just as an example, Okay, this is just an example. It could be any amount. But let's just suppose I've set aside in my family $100,000 of rainy day money. This is not money that I need for income. In fact, it can't be money for income. It's some of my emergency money for a rainy day, for who knows what will happen. It might even be the money that you set aside for long-term care because you thought, well, maybe we might need it and I'm going to need to have a lump sum of cash. So a person who has this rainy day money, it says, what could I do with that? Could I leverage it? Not debt. How could I maximize it? Okay. So with the 100,000, I create three benefits or three buckets of money. The first one is cash. And in this cash bucket, in many policies, they're not all like this. So there's a hybrid of the policies too. But in this example, if I put $100,000 in, usually in this first bucket could be anywhere from 80 to 100% of what I put in here. And so I'm going to put in this example 100,000. This cash bucket in bucket number one has a return of premium benefit. That's a fancy way of saying that if I ever needed my money back out of bucket one, I could always get to it. So think about this, those of you who are watching today. I have $100,000 that's sitting in my bank account, right? Probably earning 1/4%, maybe 0.5% if you're lucky, right? It's your rainy day money. And you know you could always access that money. Well, you could take that 100,000, put it in this policy, and did you know that I could always get access to that 100,000? In most of the policies, that 100,000 would stay level, would not grow at all for probably 12 to 13 years. And then it will start to increase over time. Okay. And by the way, the one thing that there is another difference, by the way, between a traditional policy and this, a traditional policy, it's not uncommon for there to be an increase in cost of premium over time. All of the policy benefits in this linked or this hybrid type policy are guaranteed. Okay. Whatever we set up here is going to be set in stone. So bucket one, we have 100,000. We put it in. If I ever need the 100,000 back, assuming I haven't died, assuming I haven't needed any long-term care, I can get access to that money. Okay. So the second bucket here is a death benefit. And I would say that by the way, this can be an individual policy on mother, can be an individual policy on father, it can be an individual policy on anyone. But we have found often when we're talking about, Seth, husband and wife type policies, that it's not a bad idea to have a policy that is jointly, it's for joint, it's both of them. Meaning that the death benefit is the second to die, meaning that the death benefit will not be paid until the second of the two spouses passes away. So basically, if there's a benefit to be paid to a beneficiary, it's going to go to somebody, right? It's not going to go to mom or dad or one of the spouses. So, and again, these numbers are not exact. I'm trying to teach a principle. Individual situations will be a little bit different, but we're going to say that this death benefit is 200,000. So I put in 100,000. And the second bucket here is a death benefit. It's the second to die. So if by chance mom and dad pass away, that 200,000 is going to go tax-free to the beneficiary that you put on your application. Okay, Seth? That's how that's going to run. Any questions so far?
No, not yet. Looks really good.
So we haven't talked about long-term care. So I guess the third bucket has to be long-term care, right? And it is. Yeah. I'm just going to put LTC. And this is long-term care. And so, and I'm going to say that this long-term care benefit is going to be about $6,000 per month, approximately. And that's what we shared. We were short 6. So I'm just going to keep this as an example. It could only be 5 or 5,500 or 5,900, but I'm just going to use 6,000 a month. And that benefit could be for 50 months. It could be longer, or it could be lifetime. Imagine that. I put in $100,000. I could get my money back if I didn't pass away and I didn't ever need long-term care. I could always have access to that money. In fact, I had a dentist one time who bought a couple of these policies. He came to me about 6 months later and he said, I just sold my practice and I didn't plan for the taxes very well, and I need that money back. And within 2 weeks, we had the $100,000 back in his pocket, whatever the policy was. So this hybrid policy gives you all the benefits of using your rainy day money and self-insuring, but always have access to this money. It gives you a death benefit when both of you pass away, and you've got a long-term care benefit that could be payable to you. And by the way, the long-term care benefit is a tax-free benefit under current tax law. And so really what is really happening here is that how are they able to do this? The first thing, that when the benefits come from this long-term care policy, we're accelerating the death benefit. So basically, dollar for dollar, let's suppose, as an example, I received $200,000 of long-term care out of this policy. So where's that money coming from? We're basically reducing the death benefit by the amount of the long-term care. And eventually, that death benefit is going to go to zero in this example. Let's suppose I only used $100,000 of long-term care and I died. There'd still be $100,000 of death benefit left. And so if in a base policy, once you've used up the death benefit, you've used up all the care in the policy. However, if it has a lifetime benefit to you after the death benefit has been used up, then through this special lifetime benefit, we call it a lifetime benefit rider, then that benefit would continue for a lifetime. Obviously, if you get a lifetime benefit, there's an additional premium cost. It's a pure insurance cost that's tied to this contract to do this. This has been the most popular benefit or long-term care plan that I've seen over my career for those people who have rainy day money. And what is the reason? Why do they like this? Because they like they want options. Most people want an option. And if you're concerned that you might not ever need long-term care in this contract, somebody's going to benefit. There isn't any situation, you're either going to get your money back, there's going to be a death benefit, or you're going to receive long-term care. And just knowing that I could get my money back at any time if I didn't use anything here is a great benefit for most people. Does that answer the question?
Yeah, no, thank you for that. And so let me get this straight. I can take my cash out of pocket A and put it in pocket B and create a death benefit and also create a long-term care benefit that I could never create with my own money. And I could get my money back whenever I want. Am I missing something? I mean, it seems almost too good to be true.
Well, remember, a little caveat is that not get my money back out whenever I want, because obviously if you needed long-term care, that would be reduced. But assuming there was no death and there was no long-term care, if you needed to get that money back, you would have access to that cash.
So assuming I can leave my money there, the death benefit and the long-term care will always be there.
And all of the benefits on these linked benefits are guaranteed once they're installed. It's done.
Okay. Well, Mike, we did have a question that came in from one of our clients, and they asked, at what age should someone apply for a long-term care policy?
Anytime you're buying insurance, whether it's long-term care or life insurance or a linked benefit like this, the older you are, the more expensive it becomes. So, I mean, the challenge is for all of us. I mean, if 5% of the public is buying long-term care policies, that's telling you a lot of people are not thinking about this. And so I would just say to you, you purchase it as early as you can. And because it's a lot less expensive if you're younger. And of course, what we're finding, Seth, didn't you tell me today that there's a fair number of declines on long-term care policies? Did you?
Yeah. So I read a study, and it said that of people who are applying for long-term care over the age of 65, a third of those applications are being denied. And if you're over 70, I think it was 70. Let me make sure. Yeah. No, if you're over 75, half of those applications are being denied. So if you wait if you wait too long, you run the risk of being uninsurable.
Okay, so, and the reason that probably is the case is because people are going to look for long-term care when they're already starting to have some sicknesses or illnesses, right? Am I saying that right?
Mm-hmm.
Okay.
Yeah.
And by the way, the underwriting on this is quite simplified. And that doesn't mean you couldn't be declined, but I have seen very favorable underwriting of these types of things for these hybrid type plans. All right, well, let's see. We're 4 minutes into before we have to say goodbye. I hope this has been helpful to you. It's been great. Seth, is there anything else you want to share with us before we sign off for today?
No, I don't think so. Thanks, Mike, for letting me join you today, and thanks to everyone who watched, and look forward to our next 30-minute Thursday.
Okay, thank you, everyone. Have a wonderful rest of today.